Welcome back. We've been talking about the recovery in the equity markets, but let's talk about the bond markets. And that's because they're likely to be on tenterhooks today, as the RBI had promised to review on September 8th, that is tomorrow, its decision to impose the incremental CRR of 10% on deposits garnered by the banks between May 19 and July 28. Removal of this ICRR will actually be a big relief, as it is a cost to banks. But will the RBI remove this ICRR? Latha joins in with a quick CNBC-TV18 poll. Latha.
Well, banks and bond markets are in a state of suspended animation, don't want to move this way or that because it's a big decision. No one knows, so I did a poll. And the poll says 50% are expecting the ICRR to be tweaked to 5% or thereabouts. The other is split. There are 20% or a minority which expects it to be completely removed, and another 30% which believes that it will be completely retained. Now, you know, when RBI was imposing this 10% CRR, it said that there has been excess liquidity in the system because of the 2,000 rupee notes being returned, and therefore this timing. May 19th was when they announced the withdrawal of the 2,000 rupee notes, and July 28th, that is the period in which most of the money was returned. But in reality, RBI's reason was that inflation is going to be very high for a couple of months, and they don't want to pour paraffin over this fire by putting more liquidity, and that's why the liquidity tightening. That's why the doubt in people's minds, you know, that inflation is going to be high probably even in September. So will RBI drain out? It drained out 1.1 trillion, approximately 1.1 lakh crore rupees from the system. Now, at the moment, the liquidity went into deficit, and the the daily call rate moved up towards 675 from 650. But now, again, liquidity has returned with the government spending over the month end, and therefore now there's a surplus liquidity of about 80,000 crores to 1.5 lakh crore, depending on which day you are looking at liquidity. So there is a problem in the people's mind. Oh, will they continue with the tightening? Now, the tightening of liquidity will anyway happen on September 15th because of advance tax payments. All that goes out of the banking system. So there is the other group which feels, why do it? You know, let us do, maybe they should do some short-term measures. Okay, now, here's my take. I'm being, arrogant enough to give an editor's take on this. My sense is that they are going to remove the ICRR. Simply because it's, it was designed only for that temporary liquidity, and henceforth they may play it by the year and do a VRRR, variable rate reverse repo, when there is excess liquidity. That will be to absorb. And when there is deficit liquidity, like it will be mid-September because of tax payments, they will do a variable rate repo. That is, banks can borrow from them at a variable rate. It is likely they will do that. And the end of the ICRR could also be because anyway the dollar is strengthening. So the rupee is weakening, and that will mean RBI is probably selling dollars. That also absorbs liquidity. So they have a couple of, elbow room to tackle liquidity, which is why they may end the ICRR. Then the big question is whether they will announce it before trading hours on Friday or after. My best guess, according to sources who usually are correct, is that they will announce it before trading hours. That's Friday morning.
Okay, all right, Latha. Thanks very much for that. Well,